Today we dissect China's new 10% to 15% tariffs on U.S. imports, a bold retaliatory strike against protectionism. These measures target key commodities such as coal, LNG, crude oil, and vital auto parts, poised to disrupt supply chains and production strategies. We'll explore the impact on manufacturing costs, consumer prices, and long-term competitiveness across the automotive, energy, and tech sectors. Buckle up as we navigate this evolving trade landscape and its effects on mobility. Automotive industry under turbulence. The U.S. automotive sector, a vital engine of the economy, is reeling from China's escalating trade measures. New tariffs on large engine vehicles and key components are directly affecting major players like Ford, GM, and Tesla, forcing them to reconsider supply chains and production sites. Rising import duties on essential materials such as high-grade steel, precision parts, and specialized plastics could drive up production costs, potentially leading to higher vehicle prices and slower innovation. Additionally, tariffs on Chinese-made EVs, which have surged dramatically, offer a temporary pricing edge for domestic makers while introducing long-term uncertainty as automakers balance protectionism with globalization. Industry insiders are exploring localized production and strategic alliances to maintain competitiveness. This evolving scenario challenges the industry to innovate and adapt to a shifting global landscape as challenges intensify daily. Energy sector in the crosshairs. China's retaliatory tariffs have expanded beyond automobiles into the energy sector, significantly affecting LNG, coal, and crude oil markets. With the U.S. heavily reliant on energy imports, maintaining its global export strategy is now more challenging. Beijing has imposed a 15% duty on LNG and coal and a 10% tariff on crude oil to disrupt the U.S. supply chain and drive buyers toward alternatives like Russia, Qatar, and Australia. Energy is critical for industries such as automotive manufacturing, which depends on a steady supply of affordable resources. Targeting LNG, a key export, risks reducing American energy demand and forcing firms to adjust pricing and diversify markets, thereby impacting global oil pricing. Additionally, higher crude oil costs make U.S. oil less competitive, potentially driving up production costs across industries and influencing consumer prices. Critical materials and tech. A tightening grip. China's latest trade measures target key tech and industrial materials, including tungsten, tellurium, bismuth, molybdenum, and indium, essential for modern manufacturing, from aerospace and defense to automotive components. These export controls aim to protect China's technological sovereignty while pressuring the U.S. tech and defense sectors. For the automotive industry, such materials are crucial for high-performance engine parts, braking systems, semiconductors, and solar panels, vital for electric vehicles and sustainable energy solutions. With restricted access, U.S. manufacturers may face scarcity or higher costs, delaying production and driving up vehicle prices. Analysts warn these measures will force American companies to seek alternative suppliers or invest in domestic production, increasing capital expenditure. Moreover, rising semiconductor tariffs compound supply chain challenges, underlining the high stakes in this trade war and its impact on global innovation in today's volatile market environment. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now let's shift gears and steer toward our next point: regulatory rumbles and blacklists. China's trade war has now expanded to include aggressive regulatory actions against major U.S. corporations. Beijing's antitrust probe into Google and blacklisting of companies like PVH Group and Illumina add a complex political layer to the conflict. These moves target firms whose products and services integrate with critical supply chains, including those in the automotive sector, potentially causing unexpected delays and forcing automakers to seek alternative suppliers. By scrutinizing tech giants and blacklisting prominent firms, China aims to counter U.S. protectionism and safeguard its market interests. This regulatory offensive disrupts production timelines and compels companies to diversify supply chains and invest in domestic alternatives, reshaping global trade dynamics amid heightened geopolitical tensions. Ultimately, these measures underscore the evolving nature of global economic power plays. Global aftershocks, market volatility, and supply chain chaos. China's aggressive countermeasures ripple across global markets. Tariffs on key commodities and industrial materials have triggered sudden price fluctuations, notably in the energy and tech sectors. For the automotive industry, dependent on timely deliveries and predictable costs, this uncertainty presents both challenges and opportunities. Global stock markets, particularly in the US and Europe, have reacted sharply as companies within international supply chains experience significant value drops. Automakers now face rising production costs from disruptions affecting semiconductors, plastics and metals, potentially delaying new models and squeezing profit margins. Consequently, some firms are considering reshoring production or diversifying suppliers to mitigate geopolitical risks. While this volatility complicates long-term planning, it also spurs investments in advanced digital tools and analytics, paving the way for smarter, more resilient manufacturing practices. These shifts force strategic adaptation and innovation among automakers and suppliers alike. U.S. tariff surge, shielding the EV frontier. The U.S. is stepping up protectionist measures, particularly in the electric vehicle, EV, and battery sectors, to shield domestic manufacturers from Chinese competition. Tariffs on Chinese-made EVs have surged from 25% to as high as 100%, while duties on lithium-ion batteries have increased from 7.5% to 25%. This aggressive stance aims to level the playing field by making imported EVs less competitive, thereby boosting domestic brands like Tesla and Rivian. However, these higher import duties may raise production costs, ripple through supply chains, and ultimately impact consumer prices. As the U.S. pushes for domestic sourcing of components, the market faces a delicate balance between protecting local industries and managing short-term disruptions, potentially reshaping global automotive production dynamics. This is a strategic push for domestic market leadership. China's tactical response. A new trade battlefield. China is shifting gears in the trade war by launching a comprehensive counteroffensive against U.S. tariffs. Beyond simple retaliation, Beijing has imposed a 15% duty on coal, LNG, and key industrial exports, along with a 10% tariff on products from agricultural machinery to large engine vehicles. This move aims to challenge U.S. economic dominance and secure China's long-term industrial independence by reducing reliance on imported materials. Export controls on critical minerals like tungsten, molybdenum, and indium are also in play, directly impacting sectors such as automotive manufacturing. By targeting U.S. automakers and incentivizing domestic production, China is not only inflicting economic pressure, but also reshaping global supply chains, signaling a bold new phase in its strategy for technological and industrial leadership. The final lap. Navigating the trade war's impact. As we conclude, the trade war's ripple effects are reshaping global industries, especially automotive and energy markets. Semiconductor supply chains and production models are all facing rapid change, demanding resilience and innovation. Our deep dive today uncovered the complex interplay between geopolitical strategies and market forces, highlighting the urgent need for adaptation. What do you think about the future of global trade and its impact on automotive manufacturing? Share your thoughts and experiences in the comments below. If you want to stay ahead in this evolving landscape, subscribe for the latest updates. Thank you for watching and see you next time.